Now speaking, Amir Rozwadowski, Senior Vice President, Finance and Investor Relations. Good morning, everyone. I'm Amir Rozwadowski, Head of Investor Relations for AT&T. Joining me on the call today are John Stankey, our CEO, and Pascal Desroches, our CFO. Before we begin, I want to remind you that some of our comments today may be forward-looking and subject to risks and uncertainties described in AT&T's SEC filings. Results may differ materially. You can find additional information, including our earnings materials, on the Investor Relations website. Now, I'll turn the call over to John Stankey. Now speaking, John Stankey, Chief Executive Officer. Good morning, everyone. AT&T has been executing on a strategy to drive consistent growth, simplify the company, and reduce leverage over the past 3 years. This strategy has been successful in the wireless business, with 8.3 million postpaid phone net adds, closing the gap to the industry share leader for postpaid phones by about 350 basis points, and improving postpaid phone churn by 28 basis points since the beginning of 2020. This success is evidenced by AT&T's record low quarterly postpaid phone churn in 2 of the past 3 years, as well as its #1 ranking in wireless customer satisfaction according to the American Customer Satisfaction Index. AT&T has also seen an increase in postpaid phone ARPU of more than $1 over the past 3 years. In addition, AT&T's wireless service revenues have grown by 15% and profitability has increased materially on an annual basis. The prepaid business has also seen success, with Cricket sustaining growth by continuing to add prepaid voice customers. AT&T's fiber business has seen 3.4 million net adds over the past 3 years, with an average penetration rate of 38%. AT&T's fiber net additions have outpaced the leading cable provider's broadband net additions, and fiber broadband revenues have doubled since the second quarter of 2020. The accretive mix shift to fiber has driven AT&T's broadband ARPU up by more than $10, an increase of 20%. AT&T has also achieved its $6 billion run rate savings target and expects to achieve an additional $2 billion plus in cost savings over the next 3 years. AT&T is committed to reducing its net debt by $20 billion and achieving a 2.5 times range for net debt to adjusted EBITDA in the first half of 2025. AT&T has invested $65 billion in capital investments since July 2020, passing 7 million new fiber locations and expanding its nationwide 5G network to cover approximately 290 million people. Now speaking, Pascal Desroches, Chief Financial Officer. Good morning, everyone. In the second quarter, consolidated revenues were up nearly 1%, largely driven by wireless service revenue and fiber revenues. Adjusted EBITDA was up 7% for the quarter with growth in mobility, consumer wireline in Mexico. Adjusted EPS was 63 cents compared to 65 cents in the year-ago quarter. Cash from operating activities was $9.9 billion versus $7.7 billion last year and was up $3.2 billion sequentially. Capital investment was $5.9 billion in the quarter and $12.4 billion year-to-date. We expect to move past peak capital investment levels as we exit the year. Free cash flow was $4.2 billion in the quarter and is expected to accelerate in the second half of the year. Mobility postpaid phone net adds were 326,000 with total revenues and profits at an all-time second quarter highs. Revenues were up 2%, and service revenues were up 4.9%. Postpaid phone ARPU was $55.63, up 1.5% year-over-year. We added 251,000 fiber customers with strong fiber revenue growth of 28% driving broadband revenues up by 7% year-over-year. Fiber ARPU was $66.70, up 8%. Business Solutions wireless service revenues grew 9.1%. FirstNet connections grew by about 350,000 sequentially. We plan to reduce net debt and reach the 2.5 times range in the first half of 2025. We expect to increasingly use our free cash flows after dividend to reduce debt and at a faster pace. By the end of this year, we expect to reduce net debt by around $4 billion, excluding any potential FX impacts, which will put us at about the 3 times range for net debt to adjusted EBITDA. This puts us on our trajectory to achieve the targeted 2.5 times range in the first half of 2025. Now speaking, John Stankey, Chief Executive Officer. The telecommunications industry has been using lead-clad cables in its networks for decades, as it is very stable and does not rust. However, the industry began to phase out the use of new lead-clad telecom cables in the 1950s. Despite this, some of these cables still provide important customer voice and data services, including connecting 911 service, fire alarms, and other central monitoring stations. In response to recent reporting, the company is doing additional testing at selected sites and is working with the Environmental Protection Agency to provide them with the information needed to conduct a thorough assessment of the issue. The company is also offering voluntary testing for any employee who works with or has worked with lead-clad cables on company time and at company expense. The company is confident that independent experts and long-standing science have given no reason to believe these cables pose a public health risk, but they are committed to acting responsibly should current scientific techniques develop new and reliable evidence that warrants a change in approach. Goldman Sachs analyst Brett Feldman inquired, "What visibility do you have into the second half of the year, and what headwinds are you managing through? Are you changing your go-to-market approach due to market conditions?" John Stankey replied, "Good morning, Brett. I'm feeling confident about our current situation. We had an issue with one account in the second quarter, but I'm not aware of any similar issues at this time. The market is showing more resilience than I anticipated in the fourth quarter of last year. Activity and volumes are good, and we adjust for the reported numbers to ensure they are economically valuable. When new offers are introduced, there is usually a period of freezing as consumers process them. We have moved past that now and exited the quarter in a good place. Demand remains strong and I don't see anything that gives me near-term concern. I'm taking a conservative approach to managing the business for the rest of the year, but the market is supporting healthy growth and the industry is responding well. Players are investing and making moves to ensure they can recover returns on those investments, which is good news for everyone." UBS analyst John Hoduluk inquired, "John, what actions have you taken to address the mid-teens decline in gross adds and why do you believe you are losing market share? Do you believe there is room to take similar pricing action as your competitors have done?" John Stankey replied, "Good morning, John. We saw a shift in the second quarter due to new offers in the market and a normalization of our accounts. We've been very focused on segment-wise where we're choosing to get our activity and have seen good results. We know the channels in the consumer market that we can use to intercept the right kind of traffic and have seen strong growth. We don't want empty calorie growth, so we focus on customers who pay good recurring rates and stay with us for a long period of time. We also look for opportunities to co-market multiple products into a customer, which increases lifetime values. We manage our large subscriber base effectively and look for opportunities to alter the value equation back to the customer. We do this as a normal course and it accretes into the business in terms of ARPUs. We feel comfortable about our growth characterizations and profitability numbers." Morgan Stanley analyst Simon Flannery inquired, "Can you provide an update on Capex for the second half of the year? Specifically, what is the expected range and how does it compare to the $24 billion Capex previously mentioned? Additionally, what is the plan for expanding the wireless network beyond 200 million mid-band POPs? What is the timeline for utilizing 3.45 GHz spectrum in the Internet Air or fixed wireless product?" Pascal Desroches replied, "We expect to spend roughly the same amount as last year, $24 billion. We've already spent $12.3 billion in the first half of the year and our deployment of spectrum is efficient and on track with our estimates. We're seeing progress in coverage, homes passed and fiber." John Stankey replied, "Internet Air is performing well, and we're seeing success in the product and business segments. We plan to use it surgically and selectively to reduce costs and retain valuable customers. We still have some scaling to do, but the foundation is there to use it effectively. This tool will help us manage our install base and transition out of legacy infrastructure." Morgan Stanley analyst Simon Flannery inquired, "What are your expectations for POP coverage and Capex levels in 2024? John Stankey replied, "We anticipate providing guidance on 24 later this year. We are confident that our current infrastructure and network performance is meeting customer expectations and delivering a great experience." Pascal Desroches replied, "Yes, Simon, as I mentioned in my commentary, we have passed the peak of our investments and will be exiting this year. We will provide our guidance at the same time as usual, but we do not anticipate investing at the same levels as we did in 2022 and 2023. JP Morgan Chase & Company analyst Phil Cusick inquired, "What progress have you made in deploying 3 GHz spectrum for 5G across your cell sites? How did 2Q seasonality affect the fiber business? Do you expect positive seasonality in 3Q? Pascal Desroches replied, "Good morning, Phil. We are at 175 million POPs covered at the end of the second quarter, which is on track to meet our goal of 200 million POPs for the year." John Stankey replied, "I don't think I'd characterize second quarter seasonality. We had a significant account migration issue and our competitors changed their offers, which shifted share. Device introductions drive the upgrade cycle, but it's unclear when that will happen this year. It could move numbers in 3Q and 4Q depending on the offer and the market and the devices offered. Year over year, that could impact things if there's a difference between 23 and 24. John Stankey replied, "There is a seasonal movement in fiber and broadband, likely due to less move activity in college/university work. We don't expect to see a recovery in housing movement, but we are confident in our ability to continue to add customers due to our share take opportunity. We anticipate a muted seasonality uptick in the third quarter due to less movement activity in the housing market." Citi analyst Mike Rollins inquired, "Can you provide an update on your plans for expanding your fiber and broadband footprint, and how BEAD and ACP programs are impacting those plans?" John Stanky replied, "Yes, Michael, that helps." To summarize, we have a good line of sight on 2/3 of our footprint and are confident in our ability to compete for the remaining third. We have a range of tools at our disposal to be competitive, such as our presence in communities, labor constructs, US and American-based content, and superior technology. We expect the process to unfold in 2024, with awards likely not impacting business until 2025 and beyond. Citi analyst Mike Rollins inquired, "Could you please explain the role fixed wireless plays in your broadband aspirations?" John Stanky replied, "Fixed wireless is an attractive solution for certain parts of the U.S., as it can provide internet access quickly and economically. In some states, policymakers may prefer terrestrial infrastructure, but I expect that they will run out of money before they can serve everyone. Fixed wireless is also a good catch product in areas where there is no subsidy or business case to invest in fiber. Additionally, it is a great solution for small businesses and lower end of the mid-size market, as they don't have the same bandwidth-intensive needs as consumer households." Bank of America Merrill Lynch analyst Dave Barden inquired, "John, has any government organization ever flagged the issue of lead in AT&T's network in the last 70 years? Have there been any material claims of harm due to this lead? How do credit rating agencies view this issue and how does it affect AT&T's capital allocation and dividend?" John Stanky replied, "Thanks for your question, Dave. We have a long-standing relationship with federal, state, and workplace regulators on safety issues, including lead. We have an infrastructure of health and safety organizations that ensure compliance with regulations. We also provide health plans to our employees and monitor their health. We have not disclosed any material claims related to lead cables, and the way we're talking to credit agencies is the same as what we're sharing with you." Wolfe Research analyst Peter Supino inquired, "What is the timeline for legacy network shutdowns in the consumer wireline segment, and how do margins in that business compare to those of pure-play broadband businesses in the long term?" John Stanky replied, "Peter, the shutdown process is not a date certain, but rather a rolling process. We have separated out our variable, fixed, and semi-fixed costs to know what we need to do as we move through geographies. We are recommitting $2 billion over 3 years to simplify our cost structure and shutter some of our square mileage. This will help contribute to accretion back into the margin structure of our consumer markets. Our fiber infrastructure is performing well and our customer satisfaction is high. We are confident that once we move out of the embedded cost structure, we can operate this business in a competitive manner." Raymond James analyst Frank Louthan inquired, "What is the fiber ARPU year over year, and why is it still below market? What is the total number of locations passed with fiber, and where will that total be when the project is completed? What is the total number of locations passed with fiber after the 15 million home push is completed?" John Stanky replied, "Frank, our guidance remains unchanged at 30 million locations passed by 2025. We have already passed 20 million locations and are on track to meet our goal." Raymond James analyst Frank Louthan inquired, "What progress have you made on the 15 million home project and how many remain to be built?" Pascal Desroches replied, "Frank, we're currently passing around 24 million homes with the majority of that being consumers. Our plans remain unchanged and we're pleased with the pace of our build and the take rates we're seeing." John Stanky replied, "Frank, historically, we've been a bit under the industry in terms of ARPU. This is partly due to our customer base being less established than some of the incumbent players. We also deliberately price our products competitively to encourage faster penetration. We're also consolidating products and services and doubling up households on both wireless and fixed broadband, which helps us maintain a good price point without having to discount too much. All of this gives us confidence in the business and allows us to grow our ARPUs and grow with our customers." Amir Rozwadowski replied, "Thank you, Frank. That concludes our questions for today. I appreciate everyone's time and interest in our